we're looking here at Chapter 15, PowerPoint information, and we're going to start back with retirement planning. So when we're talking about some retirement planning, although you might disagree with me, we're just going to hit on some of the brief introductions to get our mind thinking about it. There's a reason retirement planning is a whole industry in itself. It gets real complicated, but we're going to just look at some of the key concepts as it mentions here. So qualified plans provide deferral of tax on earned income. The compounding effect of deferral can be significant. So one of the types of retirement plans you can have is what they call a qualified plan. The compounding effect of deferral can be significant, as it mentioned. So it's going to let you build before being taxed, is one way to look at it. Withdrawals from qualified plans are ordinary income. So retirement is really set up so we contribute, and then when we get what they call retirement age, we can start getting that money back. And at a certain point, we either start getting that money back or we pay penalties, which can be pretty substantive. So in general, what's that range of ages? So withdrawals, if we are at least 59 and a half at the end of the year, or in the year we start withdrawing, we're okay. But if we withdraw before age 59 and a half, that means we're not really using the account for what the government decided that we should be using it for. So for any withdrawals that we take out early, there is a subject of a 10% penalty. So not only would you'd have the income included as ordinary income, and then on top of that, you'd have a 10% penalty for whatever you took out before 59 and a half. On the other side of that, withdrawals must begin, and this is with a qualified plan. Think of it more of a traditional plan. We're not talking about a Roth in this case. But withdrawals must begin when the individual reaches the age of 72. This is what you hear people talk about, the minimum distribution requirement. So believe it or not, if you get to this point and don't start taking out at least your minimum requirement, then you're going to be penalized on that, and that penalty is pretty notable. So here's some information pertaining to updates. So a 2020 CARES Act update. So it says in 2020, coronavirus-related distributions were not subject to 10% premature withdrawal penalty. So that's a good thing to note. There are a few exceptions. I know I've used medical for one of my clients that had early withdrawal, but they used it for medical that they needed to get. So there are just a few exceptions there, and this is another one they added. So if it was related to coronavirus related distributions, right, that is a lot more generous than some of the others. So although the amount of the distribution must be reported as income over a 3-year period, or you must repay it. So you can, in this specific case, and this is not for the other exceptions, you can treat it like a short-term loan and just make sure you have it put back in by 2022. Otherwise, I guess the good thing is you don't have to take it all in income in 1 year, meaning you don't have to report it all in 2020 and pay all of the tax due on it. You can at least spread it out. And it mentions in 2020, individuals were not required to receive minimum distributions. So again, that was probably not going to last long. Talking about types of qualified plans, usually it's going to be your employer-provided plan. Sometimes if you are your employer, so if you have Schedule C, you might be talking about a self-employed or Q plan or an IRA. So if you're looking at employer-provided plans, there are 2 policy objectives. The employer-provided plans should carry minimum risk for participating employees. The employer-provided plans should provide benefits in an equitable manner to all participating employees. So plans can't discriminate in favor of highly compensated employees. If you're talking about looking at it, one of the types is what they call a defined benefit plan. And you don't see this nearly as much, and you'll see why. It says the employer assumes risk and promises a retirement income stream. So whatever you're going to be getting paid back when you get the benefit is defined up front. Right there, you can see there's a lot of risk in that compared to the other one we're going to look at in a minute. Right, so the annual pension limited to the lesser of your average compensation for the employee's 3 highest compensation years or $230,000. We'll look at the numbers a little bit more. The other side of it is a defined contribution plan, and that's usually what you see now because the employer contributes a defined annual amount to each participating employee's retirement account. The employee may choose how the balance in the account is invested, and the employee bears the investment risk. So they're just committing to what they're going to put in when the contribution is made into the account, not years and years later when you're going to be getting the benefit. The annual contribution limit is the lesser of either 100% of the annual compensation or $58,000. So talking about types of defined contribution plans, some, and you'll still see this, I guess, a little bit, is a profit sharing plan. The employer contributes percentage of current earnings to employees' retirement accounts. So the company does real good. Out of the profit, they make the investment. There's the employee stock ownership plan. Employer contributes or has contributions that are invested in employer stock. Then you have 401k plans. So participating employees elect to contribute current compensation to their retirement accounts. The key is these plans are not just invested in the employer's stock. So it's seen as having less risk. The contributions are excluded from current income. This is a traditional 401k. And contribution limit is going to be $19,500 for 2021. So then how about non-qualified plans? I mentioned all of those were related to qualified. Well, they also have a type that's called non-qualified. With a non-qualified deferred compensation, the employee doesn't recognize deferred compensation as income until payment is received. So that means the employer can't deduct deferred compensation expense until the payment is made. The employer accrues a liability for unfunded deferred compensation, and this compensates top executives on a discriminatory basis. So you don't have to have that offer it to everybody or you're going to be running into issues, right? That's why you'd have a non-qualified plan for that part, that you only want to go to certain individuals or certain levels. And then it mentioned here the self-employed plan. This is usually, you have your Schedule C, so you don't have salary. You're not really going to be able to participate in the other plans unless you have multiple things going on. So if the only thing you have going on is self-employed, they came up with a way, well, how can we let those individuals make contributions? And this is the self-employed individuals can contribute and deduct the lesser of 20% of the earned income from self-employment or $58,000. And it mentions here, if the individual's business has employees, the Q plan must provide them with retirement benefits on that non-discriminatory basis. So again, you need to treat everybody equal. Okay, then they move on to talk some about the individual retirement account. Right, any individual who earns compensation or self-employment income can save for retirement through an individual retirement account. IRAs are tax exempt so that earnings on the account grow at a before tax rate. So this is the traditional. So with the traditional IRA, earnings are taxed when the owner withdraws them. With the Roth IRA, withdrawals are tax exempt, so earnings are never taxed. Right, but what the difference, and they don't really point that out here, if you're in a traditional, you get an adjustment up front when you're putting the money in. If it's a Roth, you don't get the adjustment up front, but you don't get taxed when you take it out. So there's a balancing effect there too. And it looks here at the IRA contributions. Individuals can contribute up to $6,000 to an IRA in 2021. That changes each year. The contribution limited to 100% of the compensation or self-employment income, right? So notice earned. An additional $1,000 catch-up contribution for individuals who reach age 50 by the year end. Right, so if you're over 50 or above, I guess it's a way of letting, if you're panicking, they'll at least let you make another $1,000 contribution each year. Then, as I mentioned before, Roth IRAs, the amount of maximum contribution phased down to zero for higher income individuals. Right, so there are some limitations even on the Roth. Where it gets interesting is when you work with individuals who have you contribute to one and then move it to the other. I kind of leave that for you to read for challenging. But what is there options to make a contribution to one type and then move it to another? Yes, it's been done many times. So looking at the deduction of the IRA contributions, your traditional IRAs contributions can be fully deductible, partially deductible, or non-deductible based on two factors. And that's the participation or non-participation by the individual in another qualified retirement plan. And that's what I mentioned earlier about if you have other stuff going on, or the AGI limit. So deduction fades down to zero for higher income taxpayers. Then the Roth IRAs, the contributions are non-deductible. But again, that's balanced because when you take your benefits out, they're non-taxable. Traditional, you get the benefit up front, or you can, and if you do get the benefit up front, then you're going to be taxed on the benefits related to that part. And then they mention here the IRA withdrawals. So from traditional IRAs, it noted a while ago that withdrawals must begin when the owner reaches age 72. So what are the tax consequences of your withdrawals? So when you make a withdrawal, the amount attributable to deductible contributions and accumulated earnings is taxed as ordinary income. The amount attributable to non-deductible contributions is excluded from income. So the simplest would be this would be traditional, this would be Roth. But you do run into situations, as it mentioned up here, on your limitations about the AGI, where some may be partially deductible. Those are the kind of messiest to keep up with on your documentation, because in that case, some of your withdrawals are going to be taxed, but others are not. So you need to make sure you have the documentation in place to show how you came up with what's taxed and what's not, and that you're consistent from year to year. And it touched on the Roth IRAs, but Roth IRAs, qualified withdrawals are tax exempt. Contributions are qualified if they occur after 59 and a half. So if you contribute to a Roth IRA and you take it out early, you're still going to get that penalty. So you still need to wait until your retirement age according to this 59 and a half rule. And then there's also a 5-year period beginning with year of initial contribution. So there is, I've used it once or twice where somebody had to go into a little bit early, but we made sure we set it up to where it was still being treated and used as a retirement account, right? So they were going to get, they were going to be treating it the same, like a yearly amount they were going to get. They were treating it as retirement as best as they could. So we used that as justification. It never got questioned. I'm assuming that would be a little risky, riskier than just not trying to use it. Rollover IRAs. So we talked about the traditional and the Roth. Well, just kind of keep in mind before we look at this. So you get your retirement with one company, and then it gets in an account. And then if nothing else, maybe down the road, you switch to a different employer. They use a different company, and you have a whole different account. Even if they use the same company, you're going to have a different account more than likely with that company. Right? So that's a lot of mess. It can get messy keeping up with all of that. Well, that's one reason that they have these rollover IRAs. So to help keep things organized, individuals, it's just a way for you, and it just kind of spells out, you can move money from one account to the other. You need to be careful that it goes directly from one account to the other, to your new retirement account. As long as you leave it there and treat it like you were before, then that's how you're going to be able to do this rollover. So they let you roll over and not have any tax consequences. And I guess as long as if you're in a traditional plan, this is usually where you run into issue. If you're in a traditional IRA, you need to make sure you roll it over first to another traditional IRA. That's not the same thing as moving it from a traditional IRA to a Roth IRA, right? Because some people might be tempted, well, we'll get all these tax benefits up front because we're getting our deduction. And then later on, before we get retirement age, we'll be smart. We'll move it to this Roth IRA. And that way, when we take our benefits each year, we're going to not be taxed on them. Well, no, they've caught on to that. So that would be more of a conversion. So when you convert from a traditional to a Roth, don't worry, you can do that, but they're going to be giving you, would be nice, and say the opportunity to pay tax related to that conversion. Right, so that's a little bit just in general to get our minds thinking on the retirement side. As I mentioned, some of it at least will be a little easier to understand when we look at some of the numbers when we go through our chapter related questions.